There's a new tariff in town, and he's coming to a portfolio near you. Taxes, Social Security, the ranting and raving that's going on right now is crazy. But the reality of the matter is that when it comes to retirement, Social Security is going to be one of the most important tools that you use. Now, it's important to understand that Social Security is not your retirement, it's a supplement to retirement. And I teach classes on this subject quite frequently. And what I want you to understand is that there are certain facts about Social Security that they're just facts. And one of those facts is that Social Security is going to change over time, and it's scheduled to change dramatically in the year 2033. So I want to give you some of the important impacts and the recent changes to your retirement strategy with regards to Social Security. So what is Social Security? Well, it's a government program providing monthly retirement benefits funded through payroll taxes or FICA. It's available as early as 62. There is an exception to that rule, but it's available as early as 62. And full benefits, or FRA, which is your full retirement amount, what that is that creates a number called PIA, which is your primary insurance amount, which, by the way, is the most important number on the page. And this happens at somewhere between 66 and 67. So your full retirement age for most people at this point is 67. Some are 66 and 6 months, 2 months, 10 months, whatever the case may be. Your maximum benefit is at age 70. So what this basically says is that the earliest we can take Social Security is 62. We can take our full Social Security at full retirement age, and we shouldn't wait to take Social Security past 70. So what if we do? What if we forget to take Social Security at age 70 and we don't take it till 73? Well, if you're past full retirement age, you can go what's called retroactive. So you can go 6 months back and file your Social Security 6 months back. So if you forgot to take Social Security at age 70 and say you're 70 in 3 months, you can go to the Social Security department and tell them you want to start your Social Security as much as 6 months prior to that date. Now, there's been some recent changes in 2025. The first one of which is the COLA, or the cost of living adjustment. It increased by 3.2% in the year 2025. This thing averages over the period of time, and most softwares will use an average of about 2.4%. I personally, when I'm running a Social Security report for the people I work with, I always use a number of 1.5. I underestimate what that growth is going to be because we end up having more money that way. Payroll tax wage-based increase from $160,200 to $168,600. So what does this mean? This means that they stop taking Social Security after that number. So up to $168,600, they're taking out the Social Security from your check every month. After that, they stop doing it. The potential for means testing is under congressional discussion. So what is means testing? Well, when Roosevelt put Social Security in place back in the 30s, he made two promises. The first promise was Social Security will be there when you get there. The second promise is it would never be taxed. Well, folks, along came something called the CRAP, the Clinton Reallocation Program, where they began to means test Social Security. So what this said was that if you had the means, let's say you had a pension and you had 401ks and you had rental properties and you had enough income coming in that you could take care of your needs, they began to tax up to 85% of your Social Security. Now, to be clear about that, it's not 85% tax on your Social Security. That's 85% of your Social Security is taxable. So as an example, if you had $10,000 in Social Security for the year and you were subject to an 85% taxable, that would mean $8,500 would move over into what is called your AGI, or your adjusted gross income, and then at that point it would be taxed at whatever rate you're at. Now, at age 62, let's say your benefit is $1,600. Well, that is only 70% of what your full retirement age benefit would be, which would be $2,285. And then every year you wait, it's going to go up by 8%. So at age 70, that 2285 would be $2,812, which is basically 124% of what your full retirement age benefits are going to be. Now, there's a huge risk of claiming too early. So claiming too early means you're claiming at prior to your full retirement age. So any date prior to your full retirement age, remember I told you full retirement age creates your PIA, which is your primary insurance amount. Any date prior to that date, you have risk of limited benefits. So what that means is you have to do what's called deemed filing. You must file for all benefits available to you at that time. And it can result in a permanent reduction. So in other words, you're locking that in at the lowest possible thing. It can also create higher taxable income in early retirement, less flexibility later on in life. And if you're still working, they're going to penalize you. So if you have $23,400 in earned income, whether it be W-2 or 1099 earned income, not passive, not from dividends or rental properties or things like that, but anything that's coming in the form from a business, okay, in an earned income, is going to subject you to a $1 to $2 deduction. So for every $2 you make above that $23,400, they're going to take back $1 of your Social Security. So let's go back to Social Security where we had $10,000 for the year in Social Security. But in that particular year, we made $45,000. Well, that's more than $20,000 more than what that limit is. So they're going to take back every dime of Social Security that you got. Now, that's a problem. And the reason why that's a problem is because you've locked your Social Security at the lowest possible point. It's not growing at that 8% every single year. And you're going to pay it all back. So one of the biggest mistakes I see people make is they take their Social Security because they think they have to, not because they really need to. And I quit working, I need to take my Social Security. Well, see, folks, there's other ways to get your income when it comes to retirement. You can use your other assets to make that happen. Maybe it's your IRA, your 401k, something else along those lines. Now, in the year and the month that you turn full retirement age, you can make up to $62,160, and the deduction is 3-to-1. So it's important to have a plan when it comes to taking Social Security. What's interesting about life in this accumulation stage of our life, we're accumulating money till we get to this place that's called preservation and distribution. Well, it really didn't take a plan to accumulate money. You just put money away, a dollar cost average in, so on and so forth. But folks, it's never been more important in your life to have a solid plan than when you get to the distribution stage of your life. Because if you do this wrong, it can cost you tens of thousands, hundreds of thousands of dollars, and more importantly, you could run out of money. So, what's the advantage of delaying? Well, there's an 8% increase of benefits for every year you delay past your full retirement age. And there's some tax efficient income strategies that you can use by doing Roth conversions prior to this date. Now, if you haven't learned about Roth conversions and you haven't really understood about Roth conversions, you need to reach out to us and so that we can do a Roth conversion analysis for you and show you whether or not you should be doing this, how much money you should be putting in tax deferred, how much you should put in tax free, what will your future taxes look like, and when is the best time for you to start eating your elephant, so to speak. And the other thing about delaying, it may reduce your Medicare premium surcharges. Now, there's a lot to learn about Medicare, and this is a short webinar here. We're not going to get into hours of talking about all of the things that you could do to do that. That is the purpose of sitting down and having that strategy session. Now, life expectancy is a break-even point. So typically, if you live 78 to 80, delaying pays off, meaning that waiting out to age 70 to take your Social Security makes a lot of sense. The break-even analysis shows you long-term benefits of waiting. Now, folks, this is very different whether you're single, whether you're married, whether you're divorced, whether you're a widow. It's all very different. And so sitting down and getting an analysis before taking your Social Security is almost imperative, because if you do this wrong, it's going to cost you a lot of money. When we do this analysis, we're going to do what's called a break-even chart for you. And we're going to show you that based on your life expectancy and how long the two of you live, what is the difference and how much difference will that actually be over that period of time. So here's a case study, early versus late. John's 62, his Social Security is $1,600 a month, and he lives to age 85. Well, he'll get a total number of $442,000 based on COLA and inflation over that time. And if he waits till 70, his check will be $2,812. Well, if he lives to age 85, it's $506,000. Well, that's a difference of $64,000. That's a pretty substantial number over that period of time and can make a very big difference for John over his lifetime, depending upon where his assets are. A general rule, and do you know what you call a person with a little bit of information? Very dangerous. So when you come off of this and watching this whole thing here, you're going to be very dangerous. You're going to have a little bit of information. It takes a lot more information than that to get a solid plan. But a general rule is that whoever is the highest earner as far as Social Security goes in a marriage should generally wait till age 70 to take their Social Security. The other one could be taking it as early as 62, depending upon whether they're still working or not. Because see, when the other one of those spouses dies, whichever spouse is the surviving spouse, they will get the highest of the two Social Securities. So how does taxes affect your benefits? Well, remember means testing? They tax up to 85% of your benefits. This is based on what's called provisional income formula as they apply it. And you combine Social Security planning with other tax strategies, and you could really save a lot of money on taxes if you just get proactive, all right? And the biggest problem that people have is they look right here. They can't look past the end of their nose. They can't look past the end of the year. I'm going to pay all these taxes this year. Folks, you need to be looking 20, 30 years down the road. And what is the overall effect with possibly paying the taxes today as opposed to paying them over 30 years? And in many cases, this can save you hundreds of thousands of dollars by simply having a plan. So the benefits are taxed differently, okay? So what happens with provisional income, which is one of the most depressing rules you'll ever learn, is that provisional income is made up of 50% of your Social Security. So let's say that your Social Security is $36,000 a year or $3,000 a month. That means immediately $18,000 is counted into your provisional income. Then any ordinary income, dividends, capital gains, non-taxable interest, conversions on IRAs, anything else that tax-free muni bond interest, anything else that would go into this AGI or into your provisional income is going to subject your Social Security to taxes. Now, based on that, if you're single and your provisional income is less than $25,000, then you don't have any taxes on your Social Security. But once it hits $25,000, it's up to 50% of it is taxable. And at $34,000, 85% of it's taxable. Over in the other column over here, married, it's 32, 50%, and 44, it's 85%. So having a solid plan, once again, makes a big difference. So what are the strategies to maximize my benefits? Well, delay claiming if possible. Now, this is not a 100% rule because frequently in a married couple, it may make sense for one party to take their Social Security, once again, as early as 62. Start doing Roth conversions to reduce your RMDs. See, one of the biggest nightmares for most people is that time bomb that's inside of their IRAs, 401ks, 403bs, 457s, etc., called an RMD, or required minimum distributions. People keep going along and they're not paying a lot of money in taxes, and all of a sudden they have to start taking these RMDs. Their Medicare goes up, their provisional income goes up, their Social Security becomes taxable and they jump tax brackets. And then even worse yet, one of the married couple dies and now they have to file single, and it even gets worse. Most people do not plan to fail, they fail to plan. They really have never been able to look at this stuff because, well, I have a financial planner. Well, folks, I submit to you, you have a stockbroker. And that's really not doing a financial plan. That's really not looking at a 100,000-foot view of all of these things and how is the taxes going to affect it on this and that. What are you doing to make sure that you don't pass all your money on to the government, you manage to pass it on to you and your family? So coordinating spousal benefits, considering annuities to supplement income, figuring out ways to make sure that you pay the least amount of money in taxes and maximize your benefits is how you get out there and get the most out of your Social Security. So why not just ask the Social Security Administration for advice? SSA looks to get the highest monthly benefit on the day you file. SSA cannot give you advice. It's actually against the law. SSA cannot coordinate benefits with outside assets. They do not have the access of taking that 100,000-foot view and looking to determine when is the best time for you to take your Social Security. I use some very sophisticated, very expensive softwares. One is just for Social Security. But if we do an analysis on Social Security, we go like this, we're making a mistake. See, we can figure out when is the best time to take the Social Security, but we can't figure out when is the best time to take the Social Security unless we look at the 100,000-foot view and say, well, maybe we're better off using some of these assets to get us through this period and then switch to our Social Security later on, giving us the maximum benefit we could get from Social Security. The value of professional financial advice. Well, the Social Security analysis is huge, right? And all you have to do is you can go out, there's a schedule, there's a link at the bottom here. You can set up a time. Make sure to bring your Social Security statements into that thing so that we can actually give you accurate pictures so we're not guessing. And then we'll do a retirement income analysis, and we'll do that 100,000-foot view, helping you to find out where you are, where you're going, and is your plan really working? Is it really going to get you to where you want to go? And then we figure out, how do we fill those gaps? You see, in order to retire, you must have one thing. You're not retiring without it. You must have a paycheck. And your paycheck's going to come from some known incomes. It's going to come from Social Security, pension if you're lucky enough to have one, possibly some rental properties, and then you're going to have a need. And that need's going to be up here, and in between there, you're going to have a gap. And that gap is going to have to be filled by those assets that you managed to put aside. The IRAs, the 401ks, the 403bs, the TSPs, the defined benefit plans, the stocks, bonds, mutual funds, gold, silver, cryptocurrency, annuities, life insurance, whatever it was. It's going to have to fill that need. But see, like I said, it doesn't take a plan to get here. You just keep putting money away, putting money away, putting it away. But it does take a plan to get out. If you want to optimize, if you want to live the lifestyle you've become accustomed to, adjusted for taxes and inflation out beyond yours and your spouse's life expectancy, and then pass your money on in the most tax-favorable way possible, that is going to take a plan. And you're going to have to take a 100,000-foot view of making that happen. Now, you fill those gaps with things like your Roths, your IRAs, 401ks. Now, there is absolutely nothing wrong with these accounts. It doesn't make them bad. However, there are some things about them that if you were a little bit more proactive, you could probably optimize them currently while you're still working or even after you've worked if you do it right. But you have potential for max funds for employers. And no matter what you hear me say, is when it comes to your qualified accounts, if you're getting matching and you're not putting up to that match, you're probably making a mistake. Now, it's not probably, you're definitely making a mistake. But if you're putting in above that match, you might be making a mistake. So there might be a better way to do that. Now, you get to maintain some or all control of your accounts. They're tax deductible when you contribute into them, okay? There's a potential for loss of the market. They're fully taxable at distribution except for Roths. And you take the risk in investment decisions and income distributions. Now, in addition to that, other assets that are going to fill in that gap for you are going to be your stocks, your bonds, your mutual funds, your certificates of disappointment, etc. You maintain control over your account, potential for tax advantage forms of income, long-term capital gains. Taxes are paid on earnings only. You still have to pay the taxes. You have a potential loss due to market risk, subject to reinvestment risk, no guarantee of principal protection, growth, or income, and you take the risk of investment decisions and income distribution. Now, there's something out there called an annuity, and most people have no idea what an annuity is. And if you think you do, I would suggest to you that go out to our website, go under courses, and take a course on annuities so that you can really, truly understand and not go based on this person's opinion and that person's opinion, so on and so forth. But they are variable, indexed, fixed, and immediate, okay? You maintain control over your account. If it's non-qualified, it becomes tax deferred on earnings and no mandatory distribution, so no RMDs. So I could take my CD, put it inside of an index, fixed, or a variable annuity, and it would immediately become tax deferred, and I wouldn't be getting a 1099 at the end of the year. Potential for guaranteed principal growth and income for life. This is only in the case of, well, actually income for life is in all cases, but for growth, you could get more growth out of indexed or variable. The problem with variable is you get all the growth, but you get all the losses, and there's a lot of expenses. My advice, stay away from variable, all right? They often require a longer term commitment. Permanent life insurance. This is one of the most phenomenal tools that you could use for retirement. The most underutilized asset that people have in their portfolio is their life insurance and how they're using it. You would be amazed at the things that you could do with life insurance if you really understood it. But see, most people don't understand it. Most people have death insurance. They buy the most insurance using the least amount of money for the purpose of dying, and this rule is set by the insurance company. Whereas if you went out and you bought the least insurance using the most amount of money for the purpose of living, you could grow your money tax-free, access up to 85% of it at any time tax-free, put it back if you want, get most of the gains of the market, never participate in losses, and when you died, it passed on at 2 to 3 times that amount tax-free. Now, wouldn't you want to do that? How much money would you put in that environment? Answer, as much as I could. You get control of your account, income tax-free loans, withdrawals up to cost basis, no penalties for early withdrawals, no required minimum distributions, and if you don't use it while you're alive, it passes on to your heirs and leverages up with a tax benefit. It does take time to build one. You can't build one overnight, and it is not for everyone. So some final thoughts on this subject and some things that we didn't discuss, all right? I told you that you could take Social Security prior to 62. There are some exceptions to that rule. One would be in the case of a death, okay? So you can take Social Security as early as 60 in the case of a death. And there's a few other disability things and like that will go along. But Social Security isn't going away. But changes they're not likely, they're guaranteed. So folks, if I was going to tell you what I thought was going to happen to Social Security going forward, and if you read your Social Security statements, you'll see on there they're telling you they're going to change it by 2033. Now, currently, the Trump administration is working on making some changes, and I'm not so certain that they're going to be able to do what they think they're going to do, like make Social Security non-taxable. Maybe, maybe not. If I was going to be a betting man, I would bet on this. They're going to take the age of 62, and they're going to move that up to 63 or 64. It's the earliest you can take your Social Security. They're going to take 67, the FRA, full retirement age. They're going to move that up to 68 or 69. They're going to take 70 and move that to 71 or 72. They're going to take the cap at which they stop taking your Social Security, and they're going to move that up. They're going to take the means testing to 100% instead of 85%. They're going to increase the amount of Social Security they take from your check. Right now, the predictions are somewhere around 3.63% additional amount taken out of the working population's check to support Social Security. Now, this is just a few of the things that I believe that they will do, but they will not do away with Social Security. Now, the good news is with the Doge, they're going in and they're finding this fraud, and maybe that will buy a little bit more time for Social Security before they have to make the changes, but change is certain. As a matter of fact, how do I know this? Because it's happened throughout history. When they put Social Security in place in the beginning, retirement age was 55 years old. Life expectancy was like 41, all right? It was very, very, we weren't going to live very long. As a matter of fact, we would get in retirement and we'd be on Social Security for maybe 5 years. Now our life expectancy is somewhere between 83 and 87, and we have a very high percentage of chances of making it well into our 90s. Claiming decision is crucial for retirement planning. Using these strategies to protect against taxes, inflation, and longevity. Now, when all of this is said and done, remember that the bottom line here is it's up to you. If it's going to be, it's up to me. That's the way it always works. So I can't advise you enough to sit down and talk with somebody, someone like myself that's qualified in this area, that their expertise lies in retirement, estate planning, and saving businesses taxes, okay? And run your own personal Social Security analysis with that advisor through their software. Stay informed about legislation updates, and be sure to reach out. Get that no-cost analysis. There's a link down here at the bottom. Remember, when it comes time to do all this stuff, it takes a plan. And if you don't have a plan, good luck. There's a good chance you'll run out of money. So remember to live like you're going to die tomorrow and plan like you're going to live forever, because you just might. Be sure to subscribe to our YouTube channel. Put your comments down below. Tell us, did you learn anything here today? Share this with friends, family, anybody, because this is information that everybody should be learning out there. And visit our website. Go out, take some courses on annuities, life insurance, Roth conversions, whatever it is. And remember, when you set up that no cost, no obligation strategy session, leave your checkbook at home because you don't get to buy anything. Keep smiling and make it a great day.